Hi, I'm James Robinson, and this is my stock pick of the week. This is our fifth and final video on the company Nuskin. We're looking at the company's wealth creation. And if you remember, for me, wealth creation is what kind of job has the management done in creating wealth for the shareholders. There's a number of ways that management can create wealth for the shareholders. They can do it by obviously making the stock price go up, but they can also do it by paying dividends. They can do it by buying back shares, which means I'll own a larger portion of the company. They can do it by reducing the company's debt, which means that my company will have a higher equity and a higher asset value, and frankly, more reserves should they ever need to borrow money in the future. They can do it by hoarding cash, which is money that the company has in an emergency. Obviously, all of these things, too much can be a good thing, but too much cash means that I'd like them to pay some of the dividends to me. But if the company has a bunch of cash on the balance sheet, it's axiomatic that the company's value would increase as that cash increases. Another thing they can do is retain the earnings, reinvest them in the business, and hopefully grow earnings as a result of those retained earnings being intelligently used. So those are the things we're going to look at in terms of wealth creation for Nuskin. Before I go on talking about Nuskin's wealth creation, just want to bring up a couple points. I bought 3 stocks in the last week, and I just don't have enough time to make the videos as fast as I should. So I bought stock in Nuskin, I bought stock in Ryan Airlines, and I bought stock in Storm Ruger, but I just don't have time to make the videos immediately when I present the stocks and when I buy the stock. And so if you follow me on Twitter, my handle is @RobinsonStocks, you'll get real-time information. Whenever I buy a company, I post it on Twitter, when I bought it and what price I bought it at. When I sell a stock, I do the same thing. I also will occasionally put an article or a YouTube video that I find that I think is very interesting and salient to what we're talking about. So that's on my Twitter, so follow that if you want real-time information. Also, I never ever talk about when I sell a stock in these videos, or almost never. And so if you want to know, hey, when I think it's time to get out, you should probably follow me on Twitter. The next thing is you see the map there of the world. Those are my known followers. I think it's very cool that I've got, as I'm doing these videos, people are watching it literally all over the world. It's gratifying. So if you like these videos, just drop me a line and say, hey, I'm in London, or I'm in, Kinshasa, or wherever you are, and I'll put a dot on the map for you. I'm continue to be frustrated that I have no dots in Africa. So if you're watching this from anywhere in Africa, let me know, because I want to put a dot there. It's a giant continent with no dots. And the other one is my goal is to get to 1,000 subscribers. I want to thank everyone who subscribed. I think I'm at 331 subscribers right now. I know that that's not, PewDiePie or any of these guys who have millions and millions of subscribers, but this isn't really exciting stuff. And so those of you who subscribe, it means a lot. I really appreciate it. One of the first ways that a company can pay back shares, and it's a method that is favored by a lot of managers, is to buy back shares. The reason that they buy back shares are twofold. The first one is it does increase my ownership in the company when a management buys back shares, because I own the same number of shares and there's less shares outstanding, so therefore I own a larger portion of the company. Therefore, I should get a larger amount of dividends, and the earnings attributable to my ownership in the company also increase. So that's one of the reasons that a company does it, and it's done in a tax advantage way because I don't pay any taxes even though I own a larger portion of the company. Whereas if you pay me dividends, I have to pay income tax, capital gains tax on the dividends. The other reason that it happens, frankly, is it allows management to make themselves look good. Management who is buying back shares constantly is always quoting earnings per share, not earnings, because the earnings per share will go up disproportionate to the earnings. Because again, the earnings could stay, if the earnings were flat year after year after year and the company bought back 10% of the stock every year, then the earnings per share would go up 10%, even though the earnings themselves were flat. Same thing with dividends. The same amount of dividend dollars divided over a smaller base of stock means dividends can go up, as we saw that this company did for several years. So it's in management's best interest to buy back the stock. It's probably in the best interest in most cases of the shareholder to buy back stock. And that assumes, of course, that the stock isn't too expensive when the company's buying it back. But assuming the company is paying a fair price for the shares, it's a good idea. What's interesting about this company is that it's done a great job of buying back stock. It's bought back about 50% of its stock since 2001. However, for the last 2 years, the shares outstanding have marginally increased. I don't mind that it's gone up a tiny bit. I'm sure they use that money to pay, stock options or something for their executives. I don't think they needed it for operations because I've looked at the operations. They didn't have a need for cash. But I'd like to see that number at least stay flat. I don't like the company ever issuing shares and diluting my ownership in the company. But having said that, for the last 5 and 10 years, the company has in aggregate reduced the number of shares outstanding. So it's not a real problem. I just wish I had seen different numbers the last couple of years. So what is the net effect of them buying back those shares? How does that really affect us as owners? So if you'd owned 10% of Nuskin in 2009, 10 years ago, that would mean you own 6.3 million shares. Today, through stock repurchases, your 6.3 million shares would mean your ownership in the company has increased from 10% to 11.4%. That's a 14% increase. So without spending any of your own money, you've managed to increase your ownership stake in the company by 14%. And that's in addition to have gotten dividends all that time, and the stock has gone up in that time. So it's literally free money for you, the shareholders. Even better, your earnings of the shares, your share of the company's earnings was $8.9 million. So the total amount of money the company made 10 years ago, if you'd been an owner and you just got your 10% of that, would have been $8.9 million. Today, your 11.4% of the company would be worth $19.8 million. So it's more than doubled. Again, that's on top of the fact that you've gotten dividends during that time. I looked at another way, the earnings would have gone from $1.42 a share to $3.13 a share. So not spectacular earnings growth, but when looked at through the prism of the earnings have gone up and you've made some dividends, not a bad long-term hold. Certainly one which justifies and has outstripped inflation. And so you've gotten richer in real terms by owning this stock over that period of time. So this next one is stockholders' equity. Stockholders' equity is pretty simple. It's the total assets the company has minus the total debts. That's the shareholders or stockholders' equity. And you can see since 2008, generally speaking, this has gone up every year. It reached a peak in 2015 and dropped precipitously for a couple of years and has now gone back up. There's a lot of things that can lead to a reduction in shareholders' equity, and they're not all bad. If the company buys back stock, that means they have less money because they use that money to buy back stock. And so therefore they would have less assets because the stock that they hold in the treasury is not an asset. And so therefore you would see that while the shareholders were enriched, the shareholders' equity would have decreased. So it's not always bad when shareholders' equity goes down, especially if the company is buying back stock and is paying dividends. But generally speaking, this company's shareholder equity has gone up gradually since 2018, almost in a straight line with the exception of that little bump. And so very happy with shareholders' equity, especially in light of the fact that the company generally has been buying back stock and paying dividends. So it's even more impressive they were able to increase their equity when they're giving so much money back to the shareholders. This slide looks at shareholders' equity per share. Again, you'll see that it has gone up more dramatically than shareholders' equity has gone up because the same amount of equity is being split out over less shares as a result of the stock buybacks. Not dramatically so, but I just want to show the slide. Looking at this slide, what we're really analyzing is return on assets. And what I always say is that it takes money to make money. That's axiomatic. The problem is how much money does it take to make money? If you have $100, if you need to invest $100 in a business and that business throws off $1 of return, that's actually not a very compelling investment. You really wouldn't want to make that investment. You'd be better off taking your money and putting it someplace else. On the other hand, if you had a company that had $100 invested in it and threw off $50 a year in interest, that would be spectacular. That would be $50 a year in profit, I should say. That would be a spectacular investment. You'd want to invest as much money in that company as you can. So what this chart looks at is what the typical company pays in terms of a return on asset and how this company is doing compared to the typical company. So you can see that this company has almost always been in the top 25% of companies, which is fantastic. It's actually in some years been far above the top 10% in companies, but it's been very, very static. So what I'm saying, what this chart is telling me is the management is whatever money the company is using to run its operations, it's using that money very, very efficiently. And if it can't use the money efficiently, that probably means that it's returning the money to us as a shareholder. So we like to see very high return on assets as an investor, and this company is doing a great job on that. This chart looks at almost the exact same thing, only instead of assets is looking at shareholders' equity. The difference is assets is just the total amount of cash that's being employed. Shareholders' equity looks at those assets minus debt. And so one of the things that happens is companies that have a lot of debt have very little equity, and the same amount of earnings spread over very little equity will give you a much higher return. And what that matters for us is that oftentimes when a company's return on shareholders' equity for companies that I would never invest in is very, very high. And that's because they just have too much debt, which is making it artificially easy for them to have high return on shareholders' equity. My company is almost never in the top 10% of return on shareholders' equity because they just have so much equity and so little debt. But having said that, again, this company is still in the top 25%, even with that handicap of not having a lot of debt, which is really, really good. And these are the last two slides are one of the really compelling things that makes me interested in the stock. A very high return on assets, and a very high return on shareholders' equity, to me means that company is utilizing money efficiently. And that means I don't mind them having more of my money. I don't mind if the company needs to retain earnings. In fact, I prefer it because the money that they retain is going to throw off more and more money over time to me, the stockholders. So I love the return on shareholder equity and the return on assets for this company. One of the things that a company can do to increase shareholder wealth, or does often do to hopefully increase shareholder wealth, is to retain earnings. So all that means is that some of the money that the company makes, the company keeps and says, we're going to use this to grow the business, or we're going to use this to continue to invest in ongoing operations and hopefully increase those. I don't like companies that require a lot of retained earnings. Automotive companies are sort of famous for needing a lot of retained earnings. I don't like that because that's really money that the company couldn't discretionarily decide to pay to me. The shareholder, they have to use it every year to invest in the company. That's one of the reasons I don't like companies with really high R&D, and I don't like companies with a really high inventory, because all that money that they're using for those other things is money they can never pay back to me. And I like it when they pay money to me. So this company's retained earnings is very, very low. You can see this chart. The retained earnings almost always goes up and to the right, the blue line, which is the retained earnings. What I'm always looking at is the change in retained earnings. So that's how much money they retained this year versus last year versus the year before versus the year before. And you can see that it's been very, very low for this company. And that means that the company has more and more money that they can pay to us, the shareholders, or use for the other methods that they can use to increase their business. With this slide, you see the return on retained earnings, and this is disappointing for this company. Again, when a company has very little in the way of retained earnings, you would expect massive increases in earnings over those retained earnings because there just aren't very many of them. This company's earnings have been flat for a few years, which is one of the reasons the stock hasn't performed that well. But you just sort of have to take the good with the bad. No company is going to be a 10 in every category. And it's the aggregate, it's the mosaic of what you see with the company that you have to look at. And so this is one of the things I'd like to see this company do a better job with retained earnings. But what I'd really like to see is the company just do a better job with their earnings, and the return on retained earnings will more than take care of itself. And I believe that that's what's going to happen to this company over time. But again, I want to say something else. If the company's earnings were to stay flat for a long period of time, because of the dividends they have and because they buy back shares, generally speaking, I still think we're going to do great as investors. It just won't be meteoric. So return on retained earnings for this company is a little bit disappointing, and it is what it is. Again, we've talked about this in a previous video, but the cash on hand for this company, and that's defined as cash equivalents, marketable securities, things that they could quickly and easily, almost instantly liquidate and turn into cash. Generally speaking, the company's increased the amount of cash on hand since 2008. Been a couple of ups and downs in there, but nothing dramatic. And so I'm very comfortable that this company's cash. Again, the other thing is they don't have too much cash. They don't have cash for their operations, but they're not hoarding cash. And that means that they've got a better opportunity for them to give that money back to me. I wouldn't be surprised if this company's cash stayed at this level for the foreseeable future, which is great because that means they don't need to retain it and give it back to us, the shareholders. So this is the chart that I think is very interesting. So these squiggly lines, let me just sort of go through it. This is all of the different ways that I think a company can return wealth to the shareholders and how they've all added up. So a change in debt, if the company pays back debt, I think that that's a benefit to me, the shareholder, and so that goes as a positive. Dividends, of course, is money that's paid to me, the shareholder. That's a positive. By the way, those first two require cash, right? So if they're able to keep their cash the same and buy back stock and pay back dividends, that means they've done a really, really good job of managing the operation. Then I look at the increase in cash and I add them all up and I say how much money over the last 5 years has this company created for the shareholders through stock repurchases and paying off debt and all of these different things. And you can see this company's done a very good job of creating wealth for the shareholders over the last 5 years, and that's one of the reasons that I'm very excited about it. It doesn't look like it's killing it in terms of earnings going up dramatically every year, but it's what they're doing with those earnings that's creating wealth for the shareholders that I like about this company. Here you can see the chart of my current stock portfolio. The very top line in bright green is Intel, which I don't own anymore, or stock that I sold, a percentage of my Intel stock that I sold. Everything else is currently in my portfolio. Those in green are what I consider to be very long-term holds. I think I will own those stocks a year from now or longer. The ones in blue, I'm not sure how long I'll hold. They're a little more speculative. I'm now about 90% invested in the market. So I'm getting to the point where if I come up with a good idea, if I come up with 2 good ideas, I'm gonna have to sell something to buy something, which is sort of become my default for, I don't, if you watch my video on what if I never sold, you'd see I perform pretty well if I never sold a stock. And obviously if I don't sell, I don't have the capital gain. So I'm preferring not to sell. I'm preferring to hold longer than I have in the past. But again, if I have a good idea, then I'm gonna have to sell something to buy something. The summation of this is that I'm up about 6.4% for the year. That's far outstripping the S&P 500. The column return in 2021 shows what I've done, what these stocks have done this year since January 1st. And the column on the right shows what those stocks have done since the date I purchased them. And you can see the date that I purchased them off to the left. Generally speaking, it looks like I have 1, 2, 3, 4, 5, 6, about 7 positions where I'm down, but I'm not down very much, less than 1% on 3 of those 7 positions. And most of the positions are up and up relatively significantly. So pretty happy with the portfolio and the way it's performing. That does it for Nuskin. Thank you very much for watching, and love to hear your comments below. Have a great day.